Hello viewers at home. You are welcome to my lectures on economic value added. In this lecture, I will explain the meaning of economic value added and the steps for computing the NOPAT, net operating profit after tax, and the capital employed. I will equally solve questions from past examination questions. Economic value added. Economic value added for a financial period is the economic profit after deducting the cost for the value of capital employed. Economic value added for a financial period. For a financial period is the economic profit after deducting a cost for the capital, for the value of capital employed. Economic value added for a financial period is the economic profit after deducting a cost for the value of capital employed. Meaning that you are going to use economic profit. That means economic value added. Economic value added ever equals to economic profit minus return on capital employed. Return on capital employed. Return on capital employed. That means ever equals to economic profit. Ever mean economic. That means the profit to consider or to use should be the economic profit. Economic profit minus the return on capital employed. Return on capital employed will be the weighted average cost of capital times capital employed. Capital employed. Our WACC means weighted average cost of capital. Weighted average cost of capital. That is the meaning of WACC. So you are going to use the economic profit. EVA is a measure of performance that provides a useful assessment of how much shareholders' value has been added during a period. EVA is a measure of performance that provides a useful assessment of how much shareholder value has been added during a period. EVA is a measure of performance that provides a useful assessment of how much shareholder value has been added during a period. EVA is a measure of performance that is a close approximation of economic profit. EVA is a measure of performance that is a close approximation of economic profit. So I've told you that EVA is economic profit. That means to get your economic profit, you have the NOPAT. NOPAT. Economic profit is NOPAT. NOPAT means net operating profit after tax. NOPAT means net operating profit after tax minus WACC minus WACC, which is weighted average cost of capital, times capital employed. Capital employed. That is EVA. EVA is NOPAT. Net operating profit after tax. NOPAT, it means net operating profit after tax. The net operating profit after tax to use should not be the accounting profit. It must not be the accounting profit. It must be the economic profit. Meaning that to convert the accounting profit to economic profit, several adjustments have to be made. NOPAT, adjustment have to be made to accounting profit to arrive at the estimated economic profit. You have to make several adjustments to convert the accounting profit to the estimated economic profit, because what we need is the economic profit, not the accounting profit. In order to convert the given accounting profit to economic profit, you will need to make several adjustments. The calculation of NOPAT is similar to that of the free cash flows. The free cash flows method of valuation. The calculation of NOPAT is similar to the calculation of free cash flows. So you have to make some adjustment in getting your operating profit to use for the calculation of economic value add. Adjustments to be made include adjustments. These are the adjustments to be made. Number one, promotional expenditure. Promotional expenditure. By promotional expenditure, we mean expenditure incurred for advertisement. So this include advertisement expenses, research and development expenditure, written off in accordance with expenditure written off in accordance with IAS 38, intangible assets. Then training expenses, training expenses or expenditure. So all those expenditures that have been expensed, all those expenses that have been charged as an expenses, items that have been charged as an expenses in the statement of profit or loss, those items that have been written off in the statement of profit or loss in accordance with IAS 38 should be capitalized. By capitalizing them, it means they should be recorded as an asset. That is, you are going to add them to capital employed. You add them to capital employed. Then at the same time, you also add them to NOPAT. I've told you that NOPAT means net operating profit after tax. These expenses that have been written off in accordance with IAS 38 intangible assets, you should capitalize them. By capitalize them, it means you should include them as part of the capital employed. That is the value of the assets. You should include them as part of the assets. That is number one. Number two, we have depreciation. Accountants can use the creative accounting system or approach to manipulate their profit. That is why, since we have different ways of calculating depreciation, which include the straight line method, the reducing balance, the sum of the year digits and others. So accountant can manipulate the profit in the statement of profit or loss through the application of creative accounting system, or the financial statement may be window dressed. So the accounting depreciation is not allowed for deduction. So meaning that where you have accounting depreciation, you are going to add it to NOPAT. Add your accounting depreciation to NOPAT, then at the same time add accounting depreciation to capital employed. That is, I'm talking about accounting depreciation. Accounting depreciation. Then economic depreciation now. Economic depreciation. Economic depreciation should be deducted. Subtract economic depreciation from NOPAT. At the same time, you subtract the economic depreciation from capital employed. Deduct the economic depreciation from NOPAT and from capital employed. So, but where the economic depreciation is not given, accounting depreciation will be assumed to be an approximation of economic depreciation. Where the economic depreciation is not given, you assume that the accounting depreciation is the same as the economic depreciation. So you don't need to deduct it, since it will have been charged before arriving at the accounting profit. You don't need to deduct it again, and you don't need to deduct it from capital employed. Just ignore that depreciation. Or if you at all you want to use it, that means you add it to NOPAT, at the same time you subtract it. So you may decide to ignore it. Then that means you add it to capital employed, at the same time you subtract it. So you may decide to ignore the accounting depreciation where it is the approximation of economic depreciation. Number 3, lease rental. Lease rental in the case of operating lease. Operating lease. That is in accordance with the IAS 17. Listen, IAS 17. Those lease rental, when IAS 17 was in use, and when you have the operating lease, we used to expense the lease rental. That lease rental, we don't use to capitalize it in accordance with IAS 17. But IFRS 16, both operating lease and finance lease has the same treatment in the book of the lessee. So, the lease rental now, which have been expensed, should be added back to the NOPAT. You add the lease rental to NOPAT. Then at the same time, you capitalize the lease rental by adding it to the capital employed. You add it to the capital employed and you add it to NOPAT and you deduct the depreciation on the asset. That is for the lease rental. Number 4, we have provisions, such as provisions for bad or doubtful debts. Provisions such as provision for bad or doubtful debts. So we used to, in financial statement, that is in the statement of profit or loss, we used to charge the increase in provision, we used to charge it as an expenses. The increase in provision for bad debts, we used to expense it. Why decrease? We used to treat it as an income. So now, that increase which you have charged as an expense in the statement of profit or loss, you are going to add it. You add increase in provision for bad debts. Increase in provision for bad debts. Or increase in allowance for receivables. Increase in allowance for receivables. You either call it provision for bad debts or you call it allowance for receivables. Increase, you add it. Then the decrease which you have been treated as an income in the statement of profit or loss, you subtract it. You less decrease in allowances for receivables or decrease in provision for bad debts or doubtful debts. So the decrease which have been treated as an income, you subtract it. You subtract the decrease. Now, actual provision for the year, for the period, the one relating to the opening, that is the provision for bad debts, less provision for bad debts, provision for bad debts in the opening balance from capital employed. Capital employed. You see, I mean capital employed. The provision, it is the actual provision, not the increase or decrease. The actual one relating to the opening balance is what you are going to subtract from the capital employed. The actual provision is what you are going to subtract from the capital employed. You less the actual provisions. Then we have no cash items. No cash items. No cash items. That is number 5. We have no cash items. Other no cash items which the accountant has expensed or accountant have expensed in the statement of profit or loss, you are going to add it to NOPAT. You add it to NOPAT. At the same time, you add it to retained earnings. You add it to retained earnings, which is part of your capital employed. You know, retained earnings is part of equity. So now, for our purpose, I want to give us the format for calculating the NOPAT for the purpose of economic value added. For the purpose of economic value added, I want to give us the format for calculating the NOPAT. NOPAT, I've told you that NOPAT means net operating profit after tax. Net operating profit after tax. That is NOPAT. Net operating profit after tax. Net operating profit after tax. You start with the net operating profit as per the account. NOPAT as per the financial statement. NOPAT as per financial statement. Or let me just say as per statement of profit or loss. NOPAT as per statement of profit or loss. So that is profit before interest and tax. You can call it profit before interest and tax, or you call it any before interest and tax. You either call it NOPAT or you call it profit before interest and tax. PBIT means profit before interest and tax. Where you start with profit after tax, that means you are going to add your interest. If you start with profit before tax, you add your interest back. So now, if you are starting with profit before interest and tax, you pick that from the financial statement. You now add back the following items. Add back the following. Number 1 is accounting depreciation. Accounting depreciation, where it is not the same as the economic depreciation, you add the accounting depreciation. Number 2, you add the research or development expenditure written off. Research through development expenditure written off. I mean the one that have been written off in the statement of profit or loss, the one that have been expensed is what you are going to add. Then you add increase in allowances for receivables. Increase in allowance for receivables, that is increase in provision for bad debts. You add it. Increase is what you are going to add. Then you add other non-cash items. Other non-cash items. You add it. Other non-cash items. Then you also add the lease rental. Lease rental expense in accordance with IAS 36. I'm talking about operating lease. Operating lease, not the finance lease. Operating lease and not the finance lease. The one that have been expensed, you add it. So you sum up this, you have this as the total. When you add it to this, you have this as the total. You now less the following items. You less 1, economic depreciation. You less the economic depreciation. Less the economic depreciation. Then we also less decrease decrease in allowance for receivable, decrease in allowances for receivables, that is decrease in provision for bad debts. You add it, you less it. Then you have taxes charge, you less tax. So when you less that, so after this adjustment, you arrive at the adjusted NOPAT. This is the NOPAT that will be used for the computation of EVA. This is how you arrive at the NOPAT, net operating profit after tax, that will be used for the purpose of EVA calculation. So now this tax, now let me give you the format for the working of the tax. Let me say working one. Taxes charge, or let me say working one. So this is how you get the tax that will be charged. So you start with the tax as per the statement of profit or loss. Tax, or let me say taxes as per the statement of profit or loss. The tax you have in the statement of profit or loss. Remember, in your statement of profit or loss, in accordance with IAS 12, the tax that will be expensed will comprises the current year tax. Then you start with the provision for income tax for the year. You less the over provision for prior year. You add under provision for prior year. Then you add the increase in deferred tax. You less decrease in deferred tax. So no, but for the purpose of EVA, the tax is based on cash rather than the accrual based method used in financial reporting. You know, in your financial reporting, your taxes have been calculated using accrual based principle, but you are going to use cash basis for the purpose of EVA. So now tax charge per income statement, that is statement of profit or loss, you less increase in deferred tax. You know, it is the increase that have been added before arriving at the tax expense. So you let that increase now. Increase in deferred tax. The increase that have been added when calculating the income tax to be expense is what you are going to subtract this time around. So you now add decrease in deferred tax. You know, the decrease in deferred tax had been deducted. So in arriving at the amount of tax to be expensed, so that decrease now, since it has been deducted, you are adding it back. Then you now add tax benefits on interest. Add tax benefits on interest. So after this adjustment, you arrive at the amount of tax that will be charged here. So that is the tax. The next important working is the adjustment to capital employed. Having considered the adjustment to NOPAT, so we want to consider the adjustment that will need to be incorporated in our capital employed. What are those adjustments now that you will need to make in your capital employed? So we have capital employed. Don't forget, the capital employed to be used for every calculation is the opening balance. You are starting with the opening balance of capital employed. Opening balance. Your opening balance, you know, your capital employed comprises equity, the opening balance of equity plus interest bearing debt. That is your capital employed. You use the opening balance for both. Then you now incorporate those adjustments to equity. So you have those adjustments include the accounting depreciation. I've told you that accounting depreciation will be added. Accounting depreciation. So you add it where it is given, then you deduct economic depreciation. Economic depreciation, you deduct that. Deduct the economic depreciation. Provision for bad debts. Provision for bad debts. I've told you that it's not the amount of increase or decrease you are going to consider. It is the opening balance that you are going to consider here. Then you now have the research and development expenditure written off. The one that have been written off in the statement of profit or loss, you want to capitalize it now. That is why you are adding it. Then the amortization norms, the research and development expenditure, you will need to deduct that. So this will give you the capital employed to be used for the purpose of EVA calculation. So we want to take a question as work example. This question we are going to use as work example shall be obtained from Ezikan March/July 2020 diet. March/July 2020 diet. Please subscribe to the channel so that you will continue to receive notification each time I drop a new video lecture. Epoch Power Nigeria Limited, IPN, is a power utility company providing power distribution services to the public and businesses of southern Nigeria. The company was formed when the government-owned Power Holding Company of Nigeria was broken up into regional utility companies, one of which was IPN, and sold into private ownership over 4 years ago. As a vital utility for the economy of Nigeria, power services are a government-regulated industry. The regulator is principally concerned that IPN does not abuse its monopoly position in the regional market to unjustifiably increase prices. The majority of services, 80%, are controlled by the regulator, who sets an acceptable return on capital employed ROCE level and ensures that the pricing of IPN within these areas does not breach this level. The remaining services, such as provision of meters and contracts, repair service are unregulated, and IPN can charge a market rate for this. The regulator calculates its ROCE figure based on its own valuation of the capital assets being used in the regulated services and the operating profit from those regulated services. The target pre-tax ROCE set by the regulator is 6%. If IPN were to breach this figure, then the regulator could fine the company. In the past, other such companies have paid fines amounting to millions of naira. The board of IPN are trying to drive the performance for the benefit of the shareholders. This is a new experience for many at IPN, who left the public sector 4 years ago. In order to try to better communicate the objective of maximizing shareholders' wealth, the board have decided to introduce economic value added, EVA, as the key performance indicator. The finance director has provided the following financial information for the year ending 30 September 2018. EBOC power service. You have regulated, you have non-regulated, we have 2018 total. Everything is in billion. Revenue is given, operating costs is given, operating profit is equally given. We have finance charges. Anytime you hear the word finance charges are interest. Anything that have to do with interest, that is what we call finance charges or finance costs. We have profit before tax, and then we have tax at 25%. Then we have profit after tax, which is equally given. Capital employed. We are given for 2018 and 2017 in billions. Measured from public accounts 328.5 and 318.5 for 2018 and 2017 respectively. Measured by regulator for regulated service only 389.5 and 380.5. You have notes. Note 1. Total operating costs include, we are given for 2018 and 2017. We have depreciation, we have provision for doubtful debts, we have research and development, we have other non-cash items. 2. Economic depreciation is assessed to be 41.5 billion naira in 2018. Economic depreciation includes any appropriate amortization adjustments. In previous year, it can be assumed that economic and accounting depreciation were the same. 3. Tax is the cash paid in the current year, 4.5 billion naira, and an adjustment of 0.25 billion naira for deferred tax provisions. There was no deferred tax balance prior to 2018. 4. The provision for doubtful debts was 2.25 billion naira on the 2018 statement of financial position. 5. Research and development is not capitalized in the accounts. It relates to a new project that will be developed over 5 years and is expected to of long-term benefit, to be of long-term benefits, to be of long-term benefits to the project, to the company. 2018 is the first year of this project. 6. Cost of capital of IPN, equity 16%, debt pre-tax 5%. 7. Capital structure of IPN, 40% equity, 60% debt. Required. A. Evaluate the performance of IPN using EVA. B. Assess whether IPN meets its regulatory rules target and comment on the impact of such constraints on performance management at IPN. Solution. I've told you that to calculate EVA, economic value added, there you will need to calculate the adjusted NOPAT. Let's compute the adjusted NOPAT. Adjusted NOPAT in billions of naira. Now, I've told you that you start with operating profit. I think profit before interest and tax. Profit before interest and tax. Now you go through the question. You have operating profit. You have finance charges. Finance charges mean interest. Meaning that before interest and before tax, the profit before interest and tax is the operating profit. and the total operating profit is 34.0 billion naira. So we have operating profit 34.0 billion. Then you adjust, you add. I said you add the following items. Let's check the note. Note 1. Total operating costs include, that is what have been charged as operating costs here. So the items listed here are included in operating costs. The first thing is depreciation. I've told you that accounting depreciation should not be allowed. So that is why we are going to add the accounting depreciation back. So depreciation is 29.5. So you add it. Depreciation 29.5 billion. Then we also have provision for doubtful debts. I'm telling you that it is the amount of increase in provision that will be added, while decrease should be subtracted. This is the amount charged for the year. So since it has been included, it shows that this is an increase in provision for doubtful debts. So we have provision for doubtful debts, provision for doubtful debts, and that is 1.0 billion. Then you also have research and development. So since this item have been charged as an expense, you add them. So we have research and development. Research and development. And that is 6.0 billion naira. Then we have other non-cash items, which is 3.5. Other non-cash items of 3.5 billion. So those items should be added. So we add them. Note 2. Economic depreciation is assessed to be 41.5 billion in 2018. This is economic depreciation, which should be subtracted. Economic depreciation includes any appropriate amortization adjustments. In previous year, it can be assumed that economic and accounting depreciation were the same. 3. Tax is the cash paid in the current year. You are going to deduct the tax. I've told you that any tax savings or tax benefits or tax relief, we also on interest, tax savings or tax relief on interest. So you have to offset that. I mean, you have to add it to the tax to be charged in your NOPAT. The provision for doubtful debts was 2.25 billion on the 2018 statement of financial position. So this is the one you have in the statement of financial position, and this is the amount you charge in the statement of profit or loss. I've told you that it is the amount of increase that should be expensed in the statement of profit or loss. Research and development is not capitalized. So it was not capitalized, it was written off in accordance with IAS 38. So you sum up this. You sum it up. You have 29.5 plus 1 plus 6 plus 3.5. That is total 40. So 40.0 billion. So when you add it to 34.0, you have 74.0 billion. So from this 74.0, you less the following items. Number 1 is economic depreciation. Economic depreciation. You are going to deduct the economic depreciation. So now the economic depreciation is assessed to be 41.5 billion. Economic depreciation is assessed to be 41.5 billion. So you have economic depreciation of 41.5 billion. Then tax is cash paid in the current year of 4.5 and an adjustment of 0.25 billion for deferred tax for deferred tax provisions. There was no deferred tax balance prior to 2018. So I've told you that the tax charge now, the tax charge in your NOPAT. So you start with the amount of tax expense, which is 4.75. So that is in our income statement. You deduct less increase in deferred tax, increase in deferred tax. I've told you that increase in deferred tax, which have been added in the computation of tax to be expensed, you are going to deduct it, and which is 0.25. 0.25, you less that. Then you now add tax savings by interest. The tax rate is 25%, and the interest is 11.5. The finance charge is 11.5 billion naira. 11.5 billion naira. So 25% of 11.5, and that will give us 2.88. So when you add this minus this plus this, 4.75 minus 0.25 plus 2.88, the tax to be expensed will be, the amount of tax to be used for the purpose of NOPAT is 7.38. So we now have tax, the tax of 7.38. So when you sum up this, you sum it up plus 41.5, then you have 48.88. If you subtract 48.88 from 74.0, then you have 25.12. That is the adjusted NOPAT. NOPAT means net operating profit after tax. That is the adjusted NOPAT. Having computed the adjusted NOPAT, the next thing we compute the adjusted capital employed. Adjusted capital employed. Adjusted capital employed. I've told you that the capital employed to use must be the opening balance. You are computing EVA for 2018. That means the capital employed for 2017 should be used. So you go back to where you have the capital employed. Capital employed measured from published accounts. Measured from published accounts. So, and for 2017, since you are computing EVA for 2018, you use the one of 2017, the opening balance. Know the 2017 capital employed will be the opening balance for 2018. Therefore, that of 2017 will be used. So we have 318.5 measured from published accounts. So we have capital employed. Let me call it brought forward. The one for 2017, which is 318.5 billion. 318.5 billion. Now, the adjustment now. The number one adjustment is depreciation. I said depreciation will be added to capital employed in order to get the adjusted capital employed. But look at the note on depreciation. You know, the depreciation for 2017 is 28.5, and that would have been the depreciation to have been adjusted. You know, we add accounting depreciation and deduct economic depreciation. But the economic depreciation we are given here is the one for 2018. not 2017. What we need to adjust in 2017 is that of 2017, not 2018, since capital employed to use should be the capital employed for 2017. Economic depreciation includes any appropriate amortization adjustments. In previous year, it can be assumed that economic and accounting depreciation were the same. Because of this clause, in previous year, it can be assumed that economic and accounting depreciation were the same. That means the depreciation of 28.5 given as accounting depreciation here in 2017 will also be the same as economic depreciation for that year. I've told you that where you add the accounting depreciation, where accounting depreciation and economic depreciation are the same. If you add the accounting depreciation of 28.5, you will still need to subtract economic depreciation of 28.5. The 28.5 is applicable to both, so you don't need. So instead of you adding it and subtracting, you can ignore it. Since economic depreciation and accounting depreciation are the same, you can ignore that of 2017. But where it is not the same, this will be added as accounting depreciation for 2017, while economic depreciation for 2017 will then be subtracted. Now, so we are going to ignore the depreciation because you were told that in the previous year, which is 2017, it can be assumed that the economic and accounting depreciation were the same. So we ignore the depreciation for 2017. So provision for doubtful debts. You are given 0.25. The 0.25 is what was charged as operating cost, not the balance that will be deducted in the statement of financial position. This is not the amount that will be deducted as the closing balance. No, it is the closing balance for 2017 that will be deducted from the receivables, that is from debtors or receivables, to arrive at the carrying amount of the receivables to be included in the statement of financial position. So this is what have been charged as an expenses for that year. So it is not the amount charged as an expenses you need. It is the amount that will be recorded in the statement of financial position that will be deducted from the receivables in the statement of financial position you need, not the amount expensed. Now, you were told the provision for bad debts you were given. I think you were given provision for bad debts in note 4. The provision for doubtful debts was 2.25 billion on the 2018 statement of financial position. This is what was used in 2018 statement of financial position, and this is what was charged as an expenses in 2018. Therefore, to get the amount that will be used, this is the increase in 2018. Increase means the amount by which that of 2018 exceeds that of 2017. Meaning that of 2017 is not up to 2.25 billion. It is the increase, the amount by which this one exceeds that of 2017 that have been used in the statement of financial position. So, now, to get the one used for 2017, you will need to subtract the amount expense to get the balance as at 2017. Therefore, you have 2.25 minus 1. 2.25 minus 1. So, we have provision for bad debts. Provision for bad debts or doubtful debts, which is 2.25 billion minus 1 billion. So that will give us 1.25 billion. This is the balance as at 2017. So it is this amount that will be adjusted in our capital employed. Then we have research and development. There was no research and development in 2017. So you don't have anything to adjust as regards that, since there wasn't any research and development in 2017, so you ignore that. Then you also have other non-cash items of 3 billion in 2017. So we have other non-cash items of 3.0 billion. 3.0 billion. So after incorporating those adjustments, you have 318.5 plus 1.25 plus 3. That will give us 322.75 billion. That is the adjusted capital employed. That is our adjusted capital employed. Then the next thing we need is the WACC. That is the weighted average cost of capital. So, weighted average cost of capital. You are given the cost of capital of IPN. Equity is 16%. Debt pre-tax cost of debt is 5%. And capital structures of IPN, 40% equity and 60% debt. So, you want to compute the weighted average cost of capital. Weighted average cost of capital. To learn more about cost of capital, try to watch my lecture on cost of capital. So now you have capital structure. Try to subscribe to the YouTube channel so that you will continue to receive notifications anytime I drop any video. The capital structure comprises equity and debt. Equity and debt. And you have 40%, the capital structure, 40% equity and 60% debt. We have the market value. Equity is 40%, debt is 60%. Then the cost of capital. The cost of equity is 16%. 16%. And the cost of debt is 5% pre-tax. So you have to compute the post-tax cost of debt. Post-tax cost of debt, which is pre-tax cost of debt into 1 minus tax rate. And pre-tax cost of debt is 5% into 1 minus tax rate, which is 25%. The tax rate, if you look at the operating statement, the income statement of IPN, you will see the tax. That is the rate used to get the tax charges and expenses. That is import power services. If you look at that income statement. So the post-tax cost of debt now, 1 minus 0.25 will be 0.75. 0.75 times 5, that will give us 3.75. 3.75%. The post-tax cost of debt is 3.75%. 3.75%. The next thing, you put hash total. You weight it. 0.4 times 0.6. 0.4, that is 40% of 16. And that will give us 6.4%. Then 60% of 3.75. 3.75 times 0.6. That will give us 2.25%. If you sum it up, plus 6.4, therefore, you get 8.65. Therefore, the WACC, our WACC is 8.65. That is the weighted average cost of capital. Then, we've computed the WACC. We've known our NOPAT. And we've equally known our capital employed. Therefore, EVA, we say EVA is NOPAT, the adjusted one, minus the weighted average cost of capital times capital employed. Capital employed. Our NOPAT, the adjusted one, is 25.12. 25.12. That is our NOPAT. 25.12 billion naira minus WACC. And our WACC is 8.65%. 8.65% times the capital employed. Our adjusted capital employed is 322.75. 322.75. So you have 322.75 billion naira. 322.75 billion naira. So which will be 25.12 billion naira minus, calculate 8.65% of 322.75, and that will give us 27.92 billion naira. 27.92 billion naira. So if you now subtract 27.92 billion from 25.12 billion, therefore EVA will be minus, let's subtract it, 25.12 minus 27.92, that will be minus 2.80 billion naira. This is negative EVA. So what will that be the comment? The negative EVA of IPN for 2018 implies that IPN is destroying value. IPN is destroying value instead of creating wealth for its shareholders. IPN is destroying value instead of creating wealth for its shareholders. The negative EVA, the negative EVA of IPN for 2018 implies that IPN is destroying value instead of creating wealth. Instead of creating wealth for its shareholders. Its shareholders. That is the requirement in A. Then we want to start with the requirement B of the question. So the requirement B, the target rows, the target pre-tax rows set by the regulator is 6%. If IPN were to breach this figure, then the regulator could fine the company. You are to assess whether IPN meets its regulatory rows target. You want to assess whether they meet the regulatory rows target of 6%. Regulatory rows target of 6%. So you are given target rows of 6%. Target rows mean return on capital employed, and that is 6%. Target rows is 6%. You are given the operating profit of the regulated business. Operating profit of the regulated business is 23.0%. Operating profit of the regulated business is 23.0 billion naira. Remember, this target rules is for the regulator, is set by the regulator. So meaning that the rows you need to compute to compare with this must be for the regulator. So say the rows, we say rows is operating profit over capital employed, return on capital employed, that is rows, return on capital employed. Operating profit, which is the same as profit before interest and tax, over capital employed. Any before interest and tax, or EBIT, or profit before interest and tax, PBIT, or EBIT, any before interest and tax. So now, the operating profit of the regulated business is 23.0 billion over capital employed. Now, you are given capital employed, the one measured from public accounts and the one measured by regulator. The one measured by regulator is 389.5 billion. That is for 2018. So we have 389.5 billion naira times 100. Therefore, rows. So we have 23.0 billion. 23.0 billion divided by 389.5 billion times 100. So that will give us 5.91%. Alternatively, if you don't want to compute it that way, alternatively, you may use average capital employed set by regulator. Average will be 389.5 plus 380.5 divided by 2. So if you want to use average capital employed, average capital employed, you know, the first one I've computed here, I only use capital employed for 2018. If you like, you may use the average. So which is 389.5, which is for 2018, plus that of 2017, which is 380.5 divided by 2. That will give you the average capital employed. 389.5 plus 380.5, that will give you 770 divided by 2, and that will give us 385 billion naira. Therefore, average capital employed, and that will be 385.0 billion. So meaning that the rows now computed on the basis of the average capital employed will be the operating profit for 2018, which is 23.0 billion naira, over the average capital employed 385.0 billion times 100. Therefore, rows will be 23.0 divided by 385 times 100. That will give us 5.97%. 5.97%. That is rows. Now, you are to assess whether IPN. You are to assess whether IPN meets its regulatory rows target. You want to assess whether IPN meets its regulatory rows target and comment on the impact of such a constraint on performance management at IPN. So you want to comment. Now if you look at the regulatory rows target is 6%, and the computed rows is approximately 5.97%. So we can say now let's have prescribed limit now, or prescribed limit. Prescribed limit. So, on the basis of this now, the rules generated from the regulated business, the rules generated from the regulated business of 5.97% as computed is within the limit, set by the regulator, that is 6%. So now the current return of IPN from the regulated business is so close to the limit. The current return of IPN from the regulated business is so close to the limit. Is so close to the limit. Therefore, there is little scope. There is little scope for it to increase profitability. The maximum operating profit, the maximum operating profit, that IPN could generate from its regulated business. IPN could generate from its regulated business is 23.1 billion naira. That is 385 billion naira, which is the average capital employed as computed. 385 billion naira times the target rules of 6%. This is the average capital employed we have computed by adding the one measured by regulator, which is 389.5 plus 380.5. So when you add the two and divide it by 2, that is how we got this. So no regulated activity now. No regulated activity. The constraints of the regulated business. The constraint of the regulated business, increases the importance of non-regulated activity, non-regulated activity as a better source of profit growth. As a better source of profit growth for IPN. For IPN. The operating profit margin. The operating profit margin of IPN. Let's compute that of the regulated and non-regulated business. Regulated, operating profit margin. Operating profit margin, which is operating profit over revenue. Operating profit over revenue times 100. That is the operating profit margin. Operating profit over revenue times 100. Now, you have the operating profit from the regulated business and non-regulated. From the regulated and non-regulated. Regulated operating profit is 23.0 and non-regulated is 11.0. So now, regulated services. Operating profit from regulated service is 23.0 billion and revenue is 138.0. That is revenue. 23.0 billion over revenue of 138.0 billion times 100. So, and that will give us 23.0 divided by 138.0 times 100, and that will give us 16.7%. Now, non-regulated service now. Non-regulated service. Operating profit now. From non-regulated service, operating profit is 11.0 and revenue is 34.5. 11.0 billion over 34.5 billion naira times 100. So we have 11.0 divided by 34.5, and that gives us times 100. We have 31.9%. 31.9%. So IPN should be working. This one is far greater, that of non-regulated business. The operating profit margin for non-regulated business is far greater than that of regulated service. So IPN should be working towards the expansion of its non-regulated business as a source of its profitable growth. IPN should be working towards the expansion of its non-regulated business. Its non-regulated business as a source of its profitable growth. As a source of its profitable growth. So that is the solution to the question number 4, performance management Ezikan 2020. March and July exam combined. So please subscribe to the channel. Subscribe to